And we think that silver is about to take control and vastly outperform gold. And probably much of that, we argue this time, this breakout will render highly likely another aggressive move, but one that will not pause at 50. We think this one is going to get its first pause in the 60 to 70 zone, well above the old idiot highs. I call them idiot highs because really you didn't spend any time up there. It was like phantom. It's like a day or two. Thin air. I think by going through 50, which is not technically important for us, but it is for anybody looking at a stupid price chart, is all-time new high. In real dollar terms, if silver were to match those $50 highs, it'd probably be $300 an ounce in real dollar terms, underlying decay in the money unit. But I think that's likely to occur in the next 5 to 6 months, that phase of it. That is not the end of the bull. That's just the next thunderbolt. And during that time, I think silver will basically double in relative performance to what gold does during that time. Silver is definitely going to be the better place to be.
Oh, lot to unpack there. Good info. Good info. Interesting because I would say currently we see silver 37, stays there for a short while, goes in the 35 range, stays there for a short while, gets back to 37-ish, stays there for a short while. So we see that oscillation, that volatility, if you will. And with the upside and how we're talking about momentum here, do you see anything that could cause a significant pullback? Because with gold, we never saw any significant pullback during its run up. But with silver, we're really seeing this anchorage is trying to weigh it down.
Yeah, no, I don't think anymore. I think that occurred over the last year, as I explained, from May of last year up through June of this year. There was this momentum corrective process. And if you saw our charts, you would see what I was talking about. Momentum was revealing something that you couldn't see it on a price chart. On a price chart, you saw erratic behavior.
This introduction flags a potentially high-impact conversation. Momentum, in market terms, refers to the rate of price acceleration or deceleration, a crucial leading indicator that often signals trend reversals before fundamentals catch up. The mention of silver implies volatility or structural shifts are underway. If silver's technical momentum is diverging from price or fundamentals, it could foreshadow a breakout or breakdown not visible in traditional analysis.
It seemed to be trendless, yet net on balance, it was really sideways, either side of about $32, up, down, up, down, up, down. Momentum was building a structure, what we call a structure, meaning a definable chart pattern, in this case, a perfect parallel channel that spanned an entire year when momentum was correcting from pretty high levels down to neutral levels. And then it said, okay, out of here. And it's out of here. So I suspect basically about every month going forward, we're going to see silver dramatically higher than the prior month. And I think we're not going to pause at 50. Anybody who's waiting to sell it up there again, I think is going to get bulldozed. But I think this is not a behavior pattern that's unusual for many markets, not just silver, where after a lengthy upside where there's been arm wrestling a lot of the way, up and down, confusing a lot of people. These things happen. That's reality. Markets ebb and flow. They have waves of profit taking. The question is, which one is real, meaning sustainable? None of them have been for silver. None of them have been for gold, sustainable on the downside. Even that collapse we had in April, which took it from 35 to 27.50, was back up in the 30s in a heartbeat and then new highs within a month. Okay, so you've got, if you're invested in silver, don't look at the day-to-day stuff. Even looking at price itself can be delusional, but at least look at the longer-term trend and you'll see what I'm talking about, that this arm wrestling process doesn't go on forever. And most bull markets, you get a point where you go whoosh, and people are shocked by the sudden change in the demeanor of the market. It's not what they expected because they'd been trained by the market action prior to expect this continued doubt process, going up yet in doubt. And then suddenly there's a jolt, and if you're not there, you miss it. And because it won't give you opportunities to enter. As far as we're concerned, basically all the opportunities to enter are well below us. And, but you better get in soon, because if we're correct, and I think we are, you're going to see this type of action, which will be surprising. And I bet it's correlated to certain other markets doing certain other things.
Okay, yeah, because I was going to ask, as you said, we seem to always be looking at price. You're seeing momentum. So I guess my question, and forgive me if you may have answered this, what what are the elements that make up momentum? Should I be looking at maybe one or two things, or is this a trade secret that we have to subscribe for?
Now, there's a philosophical sort of, not, there's a theoretical reason why momentum is better than looking at a price chart. First,
This moment underscores Oliver's edge. He reads momentum, not just price. Investors who wait for new highs on a price chart may miss 30 to 50% of the move, while those tracking momentum shifts can position early, before the masses react. This is especially useful in metals, where breakouts are often fast and unforgiving.
so realize price is deceptive because the thing you're measuring by is a money unit, a fiat money unit, not backed by anything but BS. Whether it's the yen, the euro, dollar, they're all backed by nothing, okay? Government, at the push of a button, can increase its supply, artificially lower the cost of money, interest rates. And for the last 15 years, 10 of those years, we've had zero rates. Free money. I mean, how hallucinogenic can you get? Okay. And so it's a distorted yardstick. So if you're measuring something with a yardstick that is changing in real value year to year, especially every decade to decade, it's distorting the price reality. So you're looking at price is not the thing you're looking at, it's the distortion in the money unit could be more of a factor than the actual asset you're looking at. Okay. Now, how do you factor that out? Well, you can't really, because you measure it by $1, let's say. What we do is we take the momentum, meaning the dynamics of the underlying asset as measured by dollars. Many markets are dull. They're just going sideways. No momentum at all. They're just, up, down, trading range type thing. Strong markets or weak markets will often have sharply rising momentum dynamics or weak momentum dynamics. That factor, by using the momentum of the asset, even though it's somewhat distorted by the money unit, just like the price of the asset is, removes you a half a step away anyway from simply measuring by the money unit itself. You're letting one of the attributes of the asset do the talking. Okay. And when you plot momentum, meaning you oscillate the price action in relationship to a given moving average, let's say, long-term or short-term average, you'll get a different visual picture of that market quite often than you will when you look at the price chart. And almost all the time, at a major top or a bottom, momentum will have warned you ahead of time clearly in a way that smacks you in the face if you had the opportunity to see a momentum chart at the right time. We don't use the wet noodle indicators. Those are the things like MACD and RSI, which are on everybody's screen for free, part of the package. Ours are more bar chart oriented, like you would look at a price chart, but they're momentum based. And again, we're looking for structure on the momentum, not whether it's just going up or down. You can have an up move in momentum that's not bullish. It's just an up and a down pattern. Okay. We look for structure, just like a price guy would. Is there a trend line? Is there a ceiling? Is there a floor? And if you're breaking it, because then momentum is saying, hey, I'm changing trend. And lo and behold, you look over at price and maybe it's not. Soon thereafter, it is. Okay. Price usually follows momentum. That's what we do.
This is a major technical alert. A horizontal resistance level, when tested repeatedly over years without a breakdown, builds stored energy. Each failed breakout attempt increases the probability of an eventual surge through that level, often resulting in a blow-off rally as shorts scramble and momentum funds pile in. The phrase, momentum compression, signals that the energy is coiling, and the longer it holds, the stronger the breakout typically is.
Yeah, I'm one of those guys looking at the MACD relative straight index. One of those guys.
Yeah.
So yeah, I'm looking in the wrong place. Hey, interesting how you're looking at silver doubling up because with platinum, um, only since April it's getting fairly close to doubling up as well. So with platinum, I wanted to know, is this, since it's only 3 months, is this more pent up energy or more, let's just say, momentum?
Platinum, a lot of people like to connect it to gold, and I think it's a great error. First off, you could overlay a long-term platinum chart with gold, and there's almost no correlation. There have been times when, yes, it was going up with gold. There have been times when the commodity complex is going up with gold, or even going down while gold's going up. For example, during 2015 to 2020, the Bloomberg Commodity Index, platinum too, were under pressure. Gold doubled during that time, while commodities were going down. Then in late 2020, when gold had already made its high in the mid 2020 level, 2070, I think was its price high in the middle of the year 2020, commodities started to explode. And yet gold didn't during that time. I think now the commodities are about to get back in sync with gold. Now, this happened back in the late 70s. It also happened in the 2008 period, 7-8 period, where commodities exploded along with gold. And I think it's about to happen again. Platinum is behaving more or less like the Bloomberg Commodity Index. It tends to inhale and exhale more in sync with the broad commodity category than it does with gold or silver. And I think platinum is not just the only one that's reasserting itself lately. Copper, all-time new highs now, was down, mucking around $4 over the last 4 or 5 months. It's now over 5 again. All-time highs. So it's not just those two metals, but there's other stuff within the commodity complex that we're looking at that is ripe for a major upturn, including crude oil, which is right now the weakest of the components in the commodity complex.
Yeah, I was going to ask you, is this in part because of, let's say, the mistrust or weaponization of the U.S. dollar? Is it maybe even on the DXY, we see the dollar, heading down a bit?
Now, the dollar index was a dull market between 2023 and 2024. If you look at a chart of it, it was like in an 8% range, meaning against the euro and the yen. That's its main components. Okay, just ho-hum. So while other markets were fairly dynamic, it was dull as heck. We labeled it the quiet one. Watch out for the quiet one. Okay. March of this year, it was 104.21 on the close. We said, that's it. It's a bear market. Okay. It then dropped down to 98, rallied, with the stock market, by the way. It dropped with the stock market during that time. Then it tried to bottom in April and turn up just like the stock market. Dollar rallied 4 full points back to 102 area. S&P continued on up. The dollar's now rolled back over and making new lows down in the 96s. We think the dollar index is now so broken on very long-term momentum that it's highly likely in a major wave down that could challenge the last major low of a decade, 15 years ago, at the 70 level. It has not been a wave creator between 2023 and 2024 because it was so dull. Nothing was going on. All of a sudden now it's become a noisemaker, and it's impacting people because if you're a foreign investor, for example, and that you bought into the U.S. stock market some years ago, we've learned that over the last several years, foreign investment in the U.S. stock market is at highest levels it's ever been. Or you're a major foreign investor in U.S. Treasury bonds. Well, it's not just the price of those assets that you care about. If all of a sudden the dollar, which is what you had to buy them with, converted your currency and bought them with dollars, if the dollar is getting kicked 10% or something, then that adds to the negative situation. So that could be a wave impactor that hurts the S&P. And I know we had in the weekend report a chart showing this, but a lot of people assume that if you have a weak dollar, that'd be good for the stock market. It is historically the total error. Dollar index bottomed in 2008 and has been in a zigzag uptrend since. S&P bottomed about 4 or 5 months later in 2009. There's been an upward zigzag process since. They're much in sync. So as the dollar breaks, it could be fuel injector to a downside in the stock market and an upside fuel injector for the monetary metals.
How about tariffs? Do you see tariffs? I mean, the continuation of these tariffs moving the needle anywhere?
It's a factor, I'm sure, but again, it's a new factor. And don't assume that if the market goes down, it's because of tariffs. Markets always get stories after a top or during a top that only just then occurred. But the reason for a major bear market is almost always what occurred before that shouldn't have occurred. Some sort of excess. The dot-com bubble, for example. When the S&P went down 50% between the year 2000 and 2002, NASDAQ 100 went down 82%. Wow, it's a wipeout. And yet everything that they told us at the dot-com top about how good the internet was, what it was going to change our lives forever, was right. In fact, it was understated. And yet it still went down 82%. Why? It got overvalued too quick. This time we have multiple factors in play. The distortion in the money unit's been even more. That means money supply growth. Artificial rates for 15 years, way below what any market would have offered. So people made decisions based on free money. A bad decision. All of a sudden it's due. A lot of people are choking when T-bonds sit there. High yields stay there. They're choking on it. That's coming due. Watch commercial real estate, we argue. We've been arguing that for some time. Don't keep looking at NVIDIA. Yeah, it's going to top too. It looks like it's topping to us. The process. In fact, it's really gone nowhere for about 2 years, if you look at it. Year and a half anyway. It was over 140 back in 2024. It's 150 something now. Wow, big deal. It's been either side of that number. But anyway, these factors are coming into play now. And I think that's further dynamic underlying the upside in the monetary metals, which is going to hit with a jolt. No longer this, let's go step by step. All of a sudden, it's white knuckle flight, and people who aren't in it have to chase it. And that's quite typical in many bull markets at some point, usually later on.